Learning objective 1, analyze financial statements for the purpose of evaluating performance and understanding the levels of management control. That's the first objective. So sentient technologies, which are the financial statements that you have in Excel file, we will analyze these statements through the whole course. Obviously, we will evaluate Sensient's financial performance relative to its competition. So we have a balance sheet, nothing to scare you. This is an actual balance sheet. You have new accounts that you haven't seen, okay? What is goodwill? What if like I have taught you, you buy a company, do an acquisition procedure. Do you buy it at book value? Do you remember that concept? If you buy a company, do you think that you will buy it at book value? Yes, there are some cases. There are cases even that below book value, you can buy a company. That's like a bargain, like you found gold. The most common cases are when there are liquidity issues in the companies. They have good profitability, they have everything, good efficiency, but if they are not liquid, they have liquidity issues, probably you can buy them below book value. What is liquidity issues? To start with that. Who can tell me what is liquidity issue?
Lack of money.
What do you think that it's more important, to be profitable or to be liquid?
I think it is to be liquid, because if you're not, you can't buy your supplies, therefore no business. Meanwhile, if you have a lot of accounts receivable, they owe you, but there will come a time, and I remember an example in the book in which you can pay and you need cash.
Yes, that's correct, Arturo. Rappi has been losing money, like profitability. They have negative profitability like for 3 years in a row. 3 years in a row. But they are very liquid. Why do you think they are very liquid? How it managed to be liquid?
Because we are paying cash.
Exactly. Yes. Everybody pays in cash. Moving on to the next goodwill. It's, for example, like I told you, when you buy a company and you pay more than the book value of that company, that it's the usual thing. Why do you think that you pay above market value? I just told you the answer, sorry. About book value, because you pay market value, right? You give a premium for what they know, for what they have done. So that premium, if you have a book value of a home or a company which is 1,000 of net assets, if you pay 2,000, this 1,000 difference, it's considered as goodwill. You gave them a goodwill. Who can tell me what's accurate expenses? Let me give you an example. Remember, guys, that even in managerial class, but it's not the topic, Edwin. You do accounting based in accrual-based accounting. Remember that? You don't do it with cash flow. That means when you have an expense like for the month, like the electricity bill, if you don't get the invoice from the electricity bill because it's bi-monthly, for example, but your company reports each month, okay? What do you think that will happen? If you don't get the invoice from the electricity bill, you can't give it to your accountant, but you need to report in January. But the electricity bill, you receive it in March because it's bi-monthly, no? It ends in February, and you receive it in the first days of March in order to pay it in the 10th of March. So what do you think that will happen when you report January income statement? Will you have electricity bill expensed out in your income statement? It's not a matter of having always. I told you that when you register something in the accounting, you need a support from it, right? Sometimes you don't need an invoice. What would you do is to make an accrual. Oh, I know that on average, each month I spend $1,000 on average. What you do as an accountant is to create an accrual for January based in what? You need to do an Excel with a proper format in order for you to support this accrual. And what you do is expense electricity bill and credit accrual expenses. What will happen is that when you get the January income statement, you will have expenses in the income statement. And the profitability ratios won't be affected because imagine that you don't have bills for all January expenditures. What would happen if you don't have all the bills from January and you don't have expenses in January? Your operating margin will go up like crazy, right? But the next month, what will happen? Because you have everything recorded in that month, all the bills in February, when you receive them, you will have a loss. That is why we based our accounting in accrual basis. Deferred taxes, even kind of difficult to explain them, but you will have them. Actually, you will need a study from this, an accounting study from deferred taxes. And this is the shareholders' equity. So nothing new in here, guys. Income statement, very easy, nothing new. There are no new accounts that you haven't seen. And the cash flow. And the first ratio that we will analyze, that it's by far the most popular yardstick of financial performance among investors and senior managers, is the return on equity, the ROE in Spanish, okay? ROE, defined as return on equity, which is the net income divided by the shareholders' equity. Who can explain to me what is the ROE and why it's the yardstick of financial performance? What's the valuable conclusion from this?
It's how much from all the capital invested in that company they converted to profit.
Okay.
So if you invest $10, if you have a ROE of 10%, it means that they create $1 of profit, right?
Yes.
And there are three determinants for ROE, which it will give you, if you apply this formula, it will give you what you did before, with just dividing the net profit and the shareholders' equity. But the important thing to learning here is that understanding the three principal components of ROE will give you the full understanding of what affects it. And as you see, what is the first formula from the ROE? Net income divided by sales. What do you think that it will gives you? Profitability. And sales divided by assets, that's called assets turnover. Okay, and the assets divided by shareholders' equity, it will give you a solvency solvency ratio. But at the end, what it's telling you, it's basically that efficiency and performance and the use of your assets will affect your ROE, meaning that everything affects your ROE. Okay, guys? So that's why it's the most common used yardstick or ratio in order to see or analyze companies. And you're watching here, in here. Obviously, with all the components from each companies, as you're watching, the profit margins, asset turnover, here they call it financial leverage, which it's also part of solvency ratios. So guys, what does it mean? These ROEs here. In which company would you invest right now with what I've told you? What are we missing? You just got the formula that it's basically dividing an income and the equity part. And the important here, and that's why you use a CFO in your companies, is that yes, the metrics tell you something, but there is a component. If investing would be that easy to just to get the ROE and I will invest in the one that gives me the more money, the most money. But there is a factor that it's not being said in the financial statement, which is the risk, financial risk. The risk is basically what makes the financial aspect difficult, guys. That's what we measure and we take care of as CFOs. And what's the first thing that gives you wider understanding of the risk? The first thing is the industry. The first thing is the industry they work that risk comes in related to profitability. What we do as CFOs, and I will explain you before we start with ratio analysis. Let me explain you. So you have yield or profitability and risk. Okay, guys? And you have this curve, meaning that higher risk comes with higher profitability and less risk comes with less profitability. So what we do as financial CFOs and in order to recommend and tell our CEOs of our company to invest in something is to maximize this equation. This equation it's everything for CFOs, meaning that if you invest in here, what does it mean? Shouldn't the chart is telling me that I'm investing in something that I'm not earning sufficient profitability for the amount of risk? I could be earning more profitability for the same amount of risk. We have a lot of formulas in order to incorporate that risk. Basically, the CFO will give you this part, the risk assessment part. Will give you the formula and the final result of the risk. But what you want to do is to maximize this, guys. Okay, there is even a huge study regarding this. It's Markowitz. You can invest. If you notice, guys, this is you have multiple industries in here, right? That means that they all have different risk rates. And when you incorporate analysis in order to define the rate for your bonds, in order to be attractive for the investors, you incorporate risk analysis and industry analysis. Okay, and yes, we will see how to define this risk rate, which is the difficult part. We used something called CAPM, which is what we study as in college, guys. There are CAPM is a linear function, very easy. It's just in order to understand it, the risk assessment, because obviously what we want to do is to analyze risk. Like if you have more risk, you have more return. And CAPM, it means capital asset pricing model. Okay, but we will see this model. We will see it, but that's not the common model used in real life. In real life, we use more advanced models. So, guys, now you know that you have to be assertive when assessing risk and profitability. Yes. That's why I explained you that drugs are the main income from Mexico, but as you see, there is a relation between profitability and risk. It's also the riskier, right? I don't want to make you drug lords in my class. So ratio analysis, guys, ratio analysis. I don't know why the book handles ratio analysis a little bit different, meaning that they don't give you like a proper order, but I will give it to you. So we have liquidity ratios, profitability ratios, solvency ratios, turnover ratios, and earning ratios. So we have learned what it's liquidity ratios. And the importance of liquidity. What is profitability ratio?
Oh, I think it's how the company is in generating value.
Perfect. And solvency ratios?
How your cash flow can, that you have money to pay your debts or your,
Yes. How do you handle your debt? Because what if you are very leveraged with debt? What if you don't have enough money to pay your interest rates or your interest? Okay. And also properly define from your companies which is better, because you have. What do you think that it's more expensive? To have debt or to have equity in your companies? It depends, Edwin. Tell me why. Free question, nice.
Because you can have debt to increase your company, or you can have equity to have more money into your company too. So it really depends on which mindset you're on.
Okay. And what do you think it's more affordable? Which one is cheaper?
I think equity.
Why do you think equity? How much the investor charge you for equity? What's the rate? So if you don't give control because you have 51% of the company, but you funded, which thing is more cheaper or cheap to have, equity or debt? With the example I'm giving you, with the example I'm giving Camila, it wouldn't be cheaper to have equity? At the end, okay, what if I get a very costly debt in order to fund my idea? Then I have 100% of the company, but I'm on all, how do you say, endrogado? You have huge debt.
What if you can't pay it back? Exactly, Edwin. That's a question. That's what I'm telling you. What is better, debt or equity? Because okay, I don't give part of my company. I stay with the 100%. But what if I can't pay it back? What if I have solvency issues? Shouldn't be cheaper the equity than the debt? What does an owner charge you to be owner in your company? What do you give back to the owner? You have a value from your company, right? That's one, with all the assets and the net assets that you will get. And you have rights to your economic benefits, right? Via dividends, via dividends. That's why they pay you. So you have a market value per share and your dividends. That's what the company gives you in return. But what if you don't have profitability? And what if you're not a public company? That meaning that you can't change your stocks for money. So you don't have market value and you don't have dividends. Sorry for telling you, but that's not the correct analysis. Yes, equity has a cost, and it's a cost based in, let me show you. It's a cost based in this formula. The investors, they do know that for more risk, they will have to earn more. So that means that they have to analyze to be close to this effective equation in order to get the proper amount of risk for the proper amount of yield, of rate, of profitability. Okay, guys? What does it mean? What does it mean is that your equity has a value, has a cost of equity. Cost of equity. It doesn't mean that it will give you this is a rate calculus, but that doesn't mean that the investor will charge you a rate. What it means is that you have to, or you need to have a proper profitability for your company according to the industry that you are in. Because if you are not, guys, if you are not, what would happen? What do you think that it will happen? If you don't have the proper profitability for the industry that you worked in, if you don't have the proper profitability and the proper efficiency for your company, the investors won't be attracted to you. They will not be interested in investing in you, because for the amount of risk that you represent, they could be investing in other companies that will give them the proper profitability that they expect. That is why you need to know about risk assessment. It's the final part of the class, but right now the first thing that everybody does as CFO, the first thing is to analyze these ratios, because at the end, as you are seeing in the turnover ratio, that it's called efficiency ratios. They will analyze how efficient are you as a company with those ratios. Oh, obviously, the profitability ratios also will give you a nice performance evaluation. Okay. So these are the ratios that we will analyze: profitability ratios, liquidity ratios, leverage ratios, and activity or efficiency ratios. Okay, all of this. So all of this are the first aspects that we will analyze and in order to get valuable conclusions from your companies. So the profit margin.
Like the ratio of profit. The sales, the remaining of the sales after all the expenses have been paid.
But shouldn't that tell you the proper use of funds?
Yes.
Yes, at the end, it's how you are spending the amounts that you. What if I give you $100 in order to start operating your company? What if you spend everything in nice meals and go to nice restaurants? Shouldn't be have an impact in your operating costs? So the proper way to analyze how they are using the funds from the companies to understand the profit margins. Okay, and so now you know the ROE, and there is another one which is the ROA, which is the return on assets. So if the ROE tells you the amount of profit that you earn per each dollar of equity, what does it tell you the ROA?
How much profitability you earn from each asset?
Exactly, from the amount of assets that you have. Remember, it is nice to have assets in your company. At the end, they are kind of a backup for your company, but it's not everything. You have to analyze in a broader perspective. A lot of assets doesn't mean always that it's a good company. And you have the case in Enron. Remember that Enron considered a lot of expenses as assets. These were just the introduction with two key components, which are which is the ROE and the ROA. Those are the yardsticks. That's the first thing that you analyze in ratio analysis. That's what gives you the ROE, ROE, which is return on investment.